24.76 billion RMB in a single quarter from a company whose ledger had read losses for the better part of a decade. That number belongs to CXMT, China's most watched dynamic random access memory manufacturer, and it landed in the first quarter of 2026 after roughly 10 years of burning capital to close the gap on Micron, Samsung, and SK Hynix. Two readings of one balance sheet metric, a gap between them that does not look like a trend, and the question of what a jump that large actually proves about where the cost curve now sits. The first reading runs from roughly 2015 through the final quarter of 2025. For that entire stretch, the gauge on CXMT's net profit line read negative. Not marginally negative, not occasionally dipping into red before recovering. Structurally negative, quarter after quarter, at the scale a company produces when it is building the physical and engineering infrastructure of a memory manufacturer from a position of relative underdevelopment. The incumbents it was chasing had decades of process optimization, mature supplier relationships, and production yields refined across multiple technology generations. CXMT was absorbing fixed costs against a revenue base that was not yet large enough to cover them. Every wafer it pushed through its fabs carried a portion of the building, the tooling, the power draw, and the engineering overhead. The cost per bit was high enough that no price the market would pay fully covered it. That is not a company in trouble. That is a company below the threshold, and below the threshold is exactly where you would expect a manufacturer at that stage to be. The accumulated deficit over that decade was large enough that a single profitable quarter could, by the company's own financial disclosures, roughly offset the total. That detail is itself a reading. It tells you the magnitude of the Q1 2026 number before you even state it. RMB 24.76 billion in 3 months. That is the now reading, dated to the first quarter of 2026, released in the context of CXMT's clearance for a listing on the STAR market. At current exchange rates, that figure is roughly equivalent to the entire annual capital expenditure budget of a mid-sized semiconductor fabrication facility. 1 quarter's profit from a company that spent 10 years in the red is enough to fund a new production line. That is not the scale of a business recovery. That is the scale of a reinvestment cycle. The delta between those two readings is not a trend. A trend is what you see when a metric moves incrementally in a consistent direction over time, quarter by quarter, improving by measurable steps. What this gauge shows is a discontinuity. For 10 years, the reading was negative. For 1 quarter, the reading was positive at a magnitude that erased the decade. That kind of movement in commodity manufacturing has a specific meaning. A dynamic random access memory fab is a fixed cost engine. Below a utilization threshold, every unit of production carries a burden of overhead costs that makes the economics unworkable at any sustainable market price. Above that threshold, the fixed costs are already absorbed. The next wafer's cost is almost entirely variable, and the margin on it is sharp. The threshold is not a dial you turn gradually, it is a step. 1 quarter you are below it, the next you are above it, and the profit does not grow slowly from that point. It arrives all at once. That is what the gauge is reading, not a trend. A step. Revenue growth tells you volume moved. A profit of this magnitude tells you cost per bit crossed the point where every incremental wafer now generates cash rather than consuming it. Those are different instruments measuring different things. A company can grow revenue while still running below its cost threshold if the volume increase is accompanied by proportional cost expansion. The profit number reports that CXMT's fixed cost base is now covered by its production volume, and what remains is positive. That is a structurally changed business, not a favorable quarter. The distinction matters for everything that comes after it. The H1 2026 revenue guidance issued alongside the IPO clearance runs from plus 613 to plus 677% year-on-year. A band of that width on a year-on-year comparison is not what normal operating growth looks like. Normal operating growth for a scaled memory manufacturer in a healthy cycle might run in the range of tens of percent, not multiples of hundreds. What the guided band is reading is a production ramp crossing a demand cliff at the same moment. The lower bound alone represents a several times over surge against the prior year base. The width of the band itself, a gap of roughly 64 percentage points between the floor and the ceiling of the guided range, suggests the ramp was still accelerating inside the period when guidance was issued. The upper end of that range was not a conservative estimate padded for comfort. It was a genuine uncertainty about how much volume would close before the half year ended. 613%, the lower bound of that band, 677%, the upper. Those figures have a mathematical property worth naming directly. They cannot recur as year-on-year comparisons once the base period is no longer subscale. The guided growth rate is large in part because the prior year comparison was small. The comparison base will not be small again. What the next reading has to answer is not whether the growth rate holds, because it will not hold as a percentage. The question is whether the absolute profit level holds, whether Q2 2026 and the second half of 2026 sustain a positive quarterly figure at a meaningful scale, or whether Q1 was the peak of a demand pull forward that partially reverses once the initial substitution wave clears. The substitution mechanism is the second reason to take the profit figure seriously as something other than a single outlier quarter. Chinese system vendors across smartphones, servers, and consumer electronics had been sourcing dynamic random access memory from the three dominant incumbents under conditions of price and supply uncertainty that the sanctions environment created. Export controls and the expanding list of restricted equipment raised the risk premium for any Chinese buyer whose supply chain ran through a United States-linked manufacturer. CXMT's domestic status removed that risk premium entirely. Buyers substituted not because CXMT's product was superior on every specification, but because supply certainty has a price, and at scale that price moves purchasing decisions. Volume followed the substitution. Revenue followed volume. Margin followed at scale once volume was large enough to push CXMT past its utilization threshold. The timing of the profit swing relative to the IPO clearance is not coincidental, it is mechanical. The STAR market listing process requires demonstrated financial viability. A company with 10 consecutive years of losses and no quarter of profitability on record cannot satisfy that requirement. The sequence that actually occurred, decade of losses, one outsized profitable quarter, regulatory clearance, reads less like a random business cycle event and more like a prepared case. That framing is not an accusation. Financial viability requirements exist precisely because they concentrate the incentive to reach a real threshold rather than to perform proximity to one. The Q1 2026 profit is the company's own stated figure, released in an IPO context, and the clearance signals that the STAR market's review process did not reject it. The profit was both a real economic event and a functional one. The capital the IPO raises converts one quarter's proof into multi-year production capacity. Without the profit quarter, no listing. Without the listing, no capital to hold the cost position the profit quarter demonstrated. The two events are not just sequential, they are load-bearing for each other. The third reason the metric moved the way it did is the one that the designers of the restrictions did not fully model. Export controls that blocked CXMT's access to leading-edge lithography equipment did not freeze the company at its 2018 capability level. They concentrated Chinese procurement into whatever domestic equipment and permitted foreign equipment was available, which forced CXMT to optimize yield and utilization at the process nodes it could actually reach, rather than chasing the nodes it could not. The companies that designed those restrictions operated on a model of linear slowdown. Restrict the inputs, slow the output, maintain the gap. What happened instead was that the constraint forced a different kind of optimization, one aimed at extracting maximum economic return from the reachable node rather than maximum technical advancement toward the frontier node. The cost curve bent around the obstacle. The wall did not hold the number. The wall is what the number bent around to get here. Three conditions on the reading are worth holding clearly. The profit figure comes from CXMT's own financial disclosures, released in an IPO context that carries regulatory incentives for favorable presentation. No independently audited result has been publicly verified at the time this script was built. The STAR market clearance signals that the review process did not reject the reported figure, but regulatory clearance and third-party audit confirmation are not the same instrument. The gauge is reading what CXMT reported, and that distinction should be attached to every use of the number. The second condition is the node gap. CXMT's profitable dynamic random access memory is produced at process nodes that lag the leading edge held by Samsung and SK Hynix. For commodity and mainstream memory applications, the bulk of the domestic Chinese market, that lag is commercially manageable. For high bandwidth memory and the most advanced configurations used in the largest artificial intelligence training clusters, the gap is not manageable at present. The quarter of profit reflects a market segment where CXMT can compete. It does not establish that CXMT has closed the process node gap. The gauge that reads positive is not the same gauge that measures leading edge capability. Those are two separate instruments, and only one of them moved. The third condition is the base effect on the revenue guidance. The 613 to 677% year-on-year band looks like the signature of explosive scale. It is also in part the arithmetic of a very low prior year comparison. As the base period normalizes, the percentage growth rate will compress mechanically. Whether the underlying profit and revenue level sustains or whether Q1 was a peak pulled forward by a wave of initial substitution orders is the question the next 2 quarters answer. The instrument names what it can see: a quarterly profit figure from the company's own disclosures in a market segment below the leading edge against a comparison base that was subscale. Those are the conditions of the reading. The delta is real and the direction is unambiguous. The magnitude should be held with the uncertainty those conditions attach to it. The gauge moved from a decade of red to 1/4 of black large enough to erase the accumulated total. That is not a normal business recovery, it is a discontinuity. Discontinuities in commodity manufacturing usually mean one of 2 things: a demand spike that reverses or a cost curve crossing that does not. The evidence available, the profit magnitude, the revenue guidance band, the IPO clearance that required demonstrated viability, is more consistent with a crossing than a spike. A crossing is permanent. A spike reverts. The restrictions that were designed to hold this gauge below zero required CXMT to optimize at the nodes it could reach rather than chase the nodes it could not. That optimization is what moved the cost per bit below the market price. The wall did not hold the number. The wall is what the curve bent around. 10 years red, 1/4 black, 10 years gone. The H1 2026 revenue print will land before this year is out. Watch whether the number lands inside the guided 613 to 677% band, above it or below it, and watch whether Q2 holds a profit at all. If both readings hold, the crossing is confirmed. If Q2 reverts, the gauge was reading a spike. One print will not settle it. 2 consecutive quarters will. The clock on that confirmation is running now. If you want to be here when those numbers land, subscribe and turn on notifications. This channel reads the gauge, both directions.